Tariffs are back, and they could shake up everything from your stock portfolio to the price of everyday goods. Trump's latest tariffs on Canada, Mexico, and China are already making waves. And whether you're an investor or just trying to make ends meet, these changes might hit harder than you think. Today in this video, we're breaking down what these tariffs really mean, how they impact the markets, what this could do to your investments, and perhaps most importantly, how they might make your everyday expenses more expensive. Let's go. Welcome back. We are here in the studio. As you can see, Rico here. And today we're talking tariffs and everything that tariffs can and will likely impact. But as always, this is not financial advice. Always do your own research and don't just follow random people on YouTube, like me. Everyone has different goals, so plan and research accordingly. And with that out of the way, let's first talk about what tariffs are. So I want to clear something up right away. No matter what you heard, what you think, or what people may want you to believe, tariffs are not paid by foreign countries. They're paid by American companies that import parts or goods. When a US business buys products from Canada, Mexico, or China, they now face an additional tax. 25% more on Canadian and Mexican goods, and 15% more on Chinese goods. Keep in mind, this isn't just stuff made outside of the US. Many of the things that are made in the USA are just assembled here. But more often than not, parts to make that item came from outside the country. Ford and GM might assemble here, but the radios, the leather, and the other parts likely came from China or some other country. It's really important for you to know that, for me to know that, because those US made or US assembled items will likely go up because of tariffs too. And these added costs, they don't just disappear. Businesses have two choices. One, absorb the extra cost and take a hit to their profits. Not likely. I don't know if how that sounds to you, but absorbing the cost, probably not the scenario. Or, and the more likely scenario, pass the cost on to consumers, which means higher prices for you and me. I'm gonna use a simple example, right? If a company imports parts from China to build, say, electronics, and a $100 part now costs $115 after tariffs, if the old retail price was $500, that company now will likely raise the final price from $500 to $575 to maintain profits which pay employees and shareholders. And do you want to bet that neither of those groups want to take a pay cut? So that means you and I end up paying more. So let's now transition into the stock market. Let's dive deeper into how these tariffs could hit different segments of the stock market. First, let's jump into the NASDAQ. The NASDAQ is particularly vulnerable because it's heavy in tech. And we'll look at some specific tech sectors just to give you an idea of this impact. So semiconductor companies like AMD, Nvidia, Intel, they face a double whammy. Not only do they source materials globally, but they also rely on Asian manufacturing. A 15% tariff on Chinese goods means higher costs for chip production, potentially reducing margins by 3 to 5% according to industry analysts. This can have a long-term lasting effect on the market and for investors. Consumer electronics. These manufacturers like Apple could see production costs rise by up to $150 per iPhone if the components from China face full tariffs. This could either cut into Apple's margin, not likely, or force them to raise prices, more likely, potentially slowing upgrade cycles. Tim Cook said that they would invest in building factories in the United States, which is good for jobs for sure, but not good for the price of an iPhone. If that $1,500 iPhone is bad now, with cheap parts and labor, a US-made iPhone could be upward of $2,000. Now let's look at software companies. These may seem immune, but they're not. Companies like Microsoft, Cisco, Adobe, they rely on hardware sales to drive their cloud and software subscriptions. If consumers and businesses buy fewer devices due to higher prices, software sales could decline as well. Consumers need hardware to make use of this software, and hardware does not age well. The ripple effects do not stop there. If tech spending slows, digital advertising could take a hit, and that would affect companies like Meta and Google, which make up a significant portion of the NASDAQ. And now let's talk about the S&P 500, because this is supposed to be the broader index, the broader stock market, right? And it's more diversified, but where could this be hit? So let's look at the auto industry. The 25% tariffs on Canadian and Mexican goods could be devastating. Ford and GM source roughly 30% of their parts from Canada and Mexico. Industry analysts estimate that tariffs could add $2,000 to $3,000 to the price of an average vehicle. Auto sales were already slowing down this year. This could accelerate that trend and potentially lead to layoffs in an industry that employs millions of Americans. Okay, now let's look at manufacturing and industrials. Companies like Caterpillar use globally sourced components for their heavy machinery. Their profit margins are already pretty thin at around 11 to 13%. This could shrink by 2 to 3 percentage points, making it harder for them to sustain a profitable business. Boeing is already dealing with production issues, sources about 20% of its components internationally. These tariffs could further complicate the recovery efforts and impact the larger airline travel industry, which impacts you and me. And then retail, this is a big one. This is where consumers like you and I will feel it the most. Walmart imports about $50 billion in goods from China annually. And even if they absorb some of those costs, tons of products will simply become more expensive. Target and Amazon face the exact same challenges. Retail analysts project that the average American household could spend $500 to $1,000 more annually because of this. Even healthcare, which is already a problem in the United States, isn't immune. Medical devices often contain components that are sourced globally. And companies like Medtronic and Boston Scientific could see production costs rise by 5 to 10%, potentially affecting everything from pacemakers to insulin pumps. We already pay the most out of pocket compared to any other first world country. Tariffs might make this even worse. Now, let's take a much closer look at covered call ETFs because I'm invested in a lot of them. And this is how I generate a lot of my income, that and high yield dividends. Comment down below if you're a high yield investor or income investor and what your thoughts are on the impact of tariffs. I'd love to hear from you and continue to add to my own perspective. There's probably stuff that I'm missing, so I want to hear from you. Okay, let's get back into it. Covered call ETFs like JEPI, QQQI, SPYI, and others use a specific strategy. They hold stocks and sell call options against those holdings to generate income. You can check out some of my older videos linked down below that will talk about some of these covered call ETFs. But this strategy performs differently depending on the market conditions, and tariffs create a very unique scenario. In the short term, tariff announcements typically increase market volatility, and we started to see that once the tariffs were announced. And that actually is a bit of good news for covered call strategies. Higher volatility means higher option premiums. So for example, when volatility measured by the VIX index increases from 15 to 25, option premiums can nearly double. This means funds like QQQI could potentially generate more income in the short term. This could be a silver lining, but also keep in mind everything else around us might be getting more expensive. Now let's look at some funds more specifically. So JEPI, which is the JP Morgan Equity Premium Income ETF. It holds a portfolio of lower volatility stocks and uses ELNs, which are called equity-linked notes, to implement its income strategy. Because JEPI tends to hold more defensive stocks, it might be less exposed to the initial tariff shock than funds tracking the NASDAQ or the S&P 500 directly. However, if tariffs persist, even those more defensive companies could see negative earning impacts, which in turn can reflect in the stock price of JEPI. QQQI focuses on the NASDAQ 100, selling covered calls on the entire index. With the NASDAQ's heavy tech concentration, QQI could experience significant underlying value fluctuations, meaning that the stock price of QQQI could show more ebbs and flows and volatility. The good news is, with that higher volatility means higher call premiums, potentially offsetting some of the underlying losses. The bad news is that if tech stocks enter a sustained decline due to the tariff impacts, QQQI's total return could suffer despite the higher income. This is definitely worth monitoring. I always look at total return to keep me sane, but seeing a dropping stock price is never fun. And then SPYI, this follows a similar strategy but tracks the S&P 500. Its broader diversification might provide more stability than QQQI during tariff turbulence, but it still faces headwinds if the market declines overall. The medium-term outlook depends on how prolonged these tariff situations become. If tariffs remain in place for 6 to 12 months, companies will start reporting earnings that reflect these higher costs. Historically, during periods of rising input costs, covered call ETFs have underperformed in total return compared to simple dividend strategies. But they provided more consistent income, which is great for an investor like me, but still worth monitoring. So the risk scenario to watch for is a market that doesn't just become volatile, but enters a significant downtrend. In that case, the income from call premiums might not be enough to offset the declining value of the underlying stocks. During the 2022 market decline, for instance, funds like QQQI still provided income, but their NAV or net asset value dropped significantly. And that reflects in the stock price. Okay, now let's talk about the elephant in the room. The impact on your daily expenses. These you will likely see first, and they will be far-reaching and potentially significant. So let's break it down by category of everyday expenses. Maybe not every day, but things that you buy year over year. So electronics. The consumer electronics sector sources about 70% of its components from China and other overseas markets. This dependency means price increases are almost inevitable. And industry analysts predict the following. So smartphones, they could cost you $100 to $200 more. Laptops could see a $75 to $150 price increase. Gaming consoles, if there's a PS6 or whatever coming out, they can jump by $50 to $100. And then smart home devices could cost 10 to 15% more. So in isolation, this may not sound bad. So if you're just buying one of those things a year, maybe it's not bad. But if you're replacing or buying these things often, it could mean less technology or waiting longer to upgrade. That $2,000 iPhone isn't too far off. All right, now groceries. The 25% tariff on Canadian and Mexican imports hits our food supply directly. Canada provides 20% of our imported food, while Mexico accounts for almost 15%. And here's what could happen to your grocery bill. So fresh produce, it's wintertime. Costs could rise 10 to 20%. With winter vegetables coming from Mexico, those would see the highest increases. Think avocados, bell peppers, cucumbers, broccoli, asparagus. These are things that we eat all the time, especially in this house. Meat prices, especially beef and pork, could jump 5 to 15% as the integrated North American meat markets adjust. Dairy products from Canada, you might see increases there from 10 to 15%. Processed foods could climb 5 to 10% because the ingredients become more expensive. Let's look at apparel. Clothing and footwear imports from China account for about 34% of all apparel sold in the US. With a 15% tariff, some of these budget clothing retailers might raise prices 5 to 10%. Think Target, Walmart. Some of your mid-range apparel could see increases of 7 to 12%. And then even these luxury brands, which typically absorb some of those costs, they might raise their prices by 3 to 5%. These may not sound like a lot, but if you add it all up with your everyday shopping, these things matter. And then finally, home goods. Things like furniture, appliances, and home improvement materials, they're heavily sourced from tariffed countries. Canada supplies 30% of the lumber we use in the United States. That's a ton. Furniture prices could climb 10 to 15%. Appliances might cost 7 to 12% more. And home improvement materials, these things could rise 8 to 15%, and that could slow down home renovation projects like your deck outside or adding that extra room, and it could also impact home building and construction companies. So the inflation impact is especially concerning. Economists estimate that tariffs could add 0.3 to 0.5% to inflation, which is not a good thing the last time I checked. This comes at a really delicate time when the Fed has been fighting to bring inflation down. And if these tariffs push inflation back up, the Fed might delay rate cuts or even implement additional rate hikes, affecting everything from mortgages to credit card interest. So you need to do your research, learn about tariffs, educate yourself, please. That's what I'm here to help do. So given these potential impacts, let's explore more detailed strategies for investors. So if you're trying to make money during these times, let's look at what we can do. So for covered call ETF investors specifically, like me, consider diversifying across different covered call strategies. JEPI's focus on lower volatility stocks might provide more stability than QQQI's tech-heavy exposure. Watch the term structure of options. If markets anticipate short-term volatility, but long-term stability, you might see higher premiums on near-term options and better long-term investments. Make sure you're monitoring the fund's NAV, net asset value, separately from the distributions. If NAV begins declining significantly, the high yields might just be partially returning your own capital, which is good for taxes, but not good for the stock price. And then consider complementing your covered call positions with some downside protection like treasury bonds or even small positions in inverse ETFs if you're more risk tolerant. For broader portfolio positioning, look at domestic focused companies that source and sell primarily within the US. Those could likely outperform during these times of tariffs. Look for businesses that specifically highlight their American supply chain in sectors like regional banks that focus on domestic lending. So those would be good banks to go after. Utilities that provide essential services with regulated returns. And healthcare providers. Not the medical device manufacturers, but the healthcare providers that serve US patients. And also think domestic energy producers that could benefit if global energy trade is disrupted. And then finally, value over growth might be the play here. Growth stocks, especially in tech, often trade at higher multiples based on future earning expectations. If tariffs squeeze these margins, these lofty valuations could contract more severely than value stocks that trade at lower multiples. And something you want to make sure you do, you invest in inflation-resistant assets that could provide more important protection. So things like TIPS, Treasury Inflation Protected Securities. These adjust with inflation and provide government-backed safety. Some select commodities like gold historically perform well during inflationary periods. I know gold has been a long run, a bull run for a while now. Real estate, particularly industrial and warehouse properties, might benefit as companies rebuild local supply chains. And you might need to adjust your income strategy, right? And this is what I'm looking at. So for covered call ETFs, I'm considering funds with active management that can adjust strike prices and expirations based on changing market conditions. And then look at covered call ETFs that focus on sectors less impacted by tariffs, like perhaps utilities or healthcare, like we talked about earlier. And fixed income investors might want a shortened duration to reduce interest rate risks if tariffs push inflation higher, forcing the Fed to delay rate cuts. And for long-term investors, remember that tariff situations are typically fluid. They can be announced suddenly, but they can also be modified and removed based on negotiations or economic impacts. Dollar cost averaging into quality companies during market volatility has historically been a winning strategy over the long term. And this is the exact strategy I use in my retirement accounts. So if you haven't seen that, I have a video where I talk about what I do in my retirement accounts and what I do in my taxable accounts. Tariffs aren't just about abstract policy. They have real world impacts on markets, portfolios, and your everyday expenses. For covered call ETF investors like me, the initial volatility might boost income, but watch for longer term impacts on the underlying assets. Stay diversified, be strategic about sector exposure, and remember that reactive policy changes like tariffs often create both risks and opportunities in the market. So, I would love to hear what you think. Are you adjusting your portfolio because of these tariffs? Let me know in the comments down below. And if you found this breakdown helpful, especially the deep dive on covered call ETFs, hit that like button, subscribe if you haven't already for more market insights, and turn on notifications so you don't miss my next video. Until next time, if it doesn't challenge you, it doesn't change you. Thanks so much for watching, take care, and I'll see you next time. Peace.